Hey, everybody. I wanted to explain here, by the way, Danny Griffin, founder of the Griffin Realty here, and I want to explain all this noise that we heard this week about the inverted yield curve. What the heck is this thing, and why does everybody keep talking about it like it's such a big deal? And why did it help the stock market have its biggest correction in all of 2019? Well, it has a lot to do with perception, but there are some very basic economics here that can be easily understood. So on the graph here, and we're talking about treasury bonds. This is the way the US government funds itself on a regular basis. Bonds are sold to the marketplace, and anybody in the free market system has access to buy these. Now, really, it's just a basic financial instrument that's being sold. It's a stream of payments into the future that has a certain yield as measured in a percentage rate typically, right? So the yield is the return on that investment. The maturity is the number of years when that bond becomes due and payable back in full. So like most financial instruments where there's a borrowing of money, there's an interest paid back to the lender. So in this case, the lender is the marketplace. Whoever buys these bonds puts their money in, the interest is due, and the US government has to pay that money back in those terms of years. So in other words, what you heard, and everybody watches this closely, the 2-year treasury bond, in other words, a couple of years into its maturity, it's due, versus the 10-year. So let's put that up in the graph here, just so we have the 2-year, and let's put out somewhere out here, the 10-year treasury bond, okay? I should put that up here, T-bonds. We'll put that up here, okay? So the treasury bonds are what we're talking about in this case, so you understand this. And again, I'm going to relate this to real estate, but I have to get there with the basics first. Now, you would imagine, and it's much like, think about it like going to your local bank, your CD. If you put money into a 6-month CD, well, the yield or the interest rate seems tiny, but you're only giving that financial institution 6 months to work with your money. So the shorter the term they have to work with your money, the less perceivably or projectedly they can do with it. Whereas the government works the same way. Almost think about the government like a bank. And in the same way, they're going to typically give you a lower yield. Let's pick a point here somewhere on the graph. Let's just say it's in this range here. They're going to give you typically less if you lend them your money for 2 years. Whereas out of 10 years, we would expect it's a higher interest rate out here. So we get a curve, and that's what happens. And it goes through the levels in the years, but I just want to keep this simple because this is what everybody's talking about, the 2-year versus the 10-year. Well, simply put, if we to project out, we see what happened this week, we see that, let's put a point somewhere down below that one. We see that this curve went like this and curved downwards, right? That's all there is to this. I mean, again, it's a little bit slight here. You can see it, but it curves in the other direction. Now, what does that mean? It means that the marketplace somehow, with all the variables, now there are a lot of variables that affect this. So to chunk it up and simplify the concept, there are a lot of variables that drove that long-term yield downwards. There's a lot of pressure on that. It's downward pressure. So it inverts this yield curve. And that's what everybody's worried about at this moment in time. Because why? This can be. It is not necessarily an indicator that we are in a recession. It can be one of the predictors that we are headed into a recessionary growth period for the overall economy. So the prediction of the future could potentially be worse than where we stand today, or at least in the short term. In other words, looking out 10 years, the projection is maybe things aren't so good economically speaking. So we have this inverted. Now, what does this mean for the real estate industry if you own a piece of property? And how does it relate furthermore to mortgage rates, which have a big deal in our industry? And they have been incredibly low for a long time. So I think what's really interesting to notice about this is that there's been much discussion outside of real estate in the stock market about how great things are, how great economic growth is. But yet I live in the real estate industry, and I also live globally across the United States and in some parts of Canada as a coach of other real estate agents, which gives me an incredible opportunity to look into all these marketplaces. And there are so many variables that you have to take one area at a time. So for example, if economic growth is happening in places like Seattle because of Amazon's explosive growth, or Atherton and Palo Alto areas in California because of Facebook and Google's growth, well, then you have economic factors that are driven by big business and change that buoy the real estate economy as people move in. They make more money at these companies. They spend it locally to live. Now, is that the same for other economically depressed areas? Of course not. This winter, I was in parts of Detroit where there are still an enormous amounts of undeveloped, dilapidated properties. So there's nothing driving that economy, but yet the same economy generally is spoken about. So when it comes to real estate, it's important to look at a hyper-local way. What does this mean? And what could this predict? So for buyers, we have this incredible perfect storm where interest rates have been low ever since the last recessionary period, which really had its roots in about halfway through 2009. You could go backwards and look at economic indicators that predicted that back then as well, but interest rates have never really crept up that high. So there's been a certain fragility to the economy in general, which has continued to buoy us through this last economic growth period. So lots of variables, and it's confusing. But if you are a buyer, it's important to begin to understand that interest rates are at an unbelievably historic low point. So it's a great time if you're putting a mortgage on a property to consider buying now. Now, you might say in the same breath, yes, but I'm going to wait till it crashes. Well, it may or may not have a significant crash, but certainly a correction. But what I always feel is when I'm buying, there's always a good deal to match up with the low interest rates of the day. And you can predict by looking back at the last recession how far off prices dropped. Okay, so you can go back and predict, and you don't just make it up. There's math to all of this, but there's also simple explanation. But the most important thing to understand is there is some indication, at least, that the economy is cooling. For sellers, it doesn't mean disaster. What it means is you must be strategic when selling your property. We have a 7-point plan at the Griffin Realty Group that we walk our clients through, and even before their clients, we educate the public about the 7 steps to selling. And the very first one is being realistic about the price range within which you would trade or sell right now, given today's economic circumstances, where you're at. And if you were motivated to sell on a scale of 1 to 10 today, regardless of this inverted yield curve, and you've done all of the right fix-ups, you've been guided by somebody like us to prepare the property correctly, you are in a good spot, even though it might indicate that buyers are gaining some leverage. Unique location, great condition, priced well, sellers still have that power. So regardless of the direction, in fact, the irony is, as we have economic pressures in general on yields and interest rates, that tends to have the whole banking industry, the mortgage banking industry, put pressure on interest rates for mortgage rates, right? So there's downward pressure everywhere. So the irony is, if you are a seller well prepared, there's a bigger pool of buyers that are being drawn out by the banks, offering these unbelievably low interest rates, which gives more purchasing power. So again, don't look to be persuaded. I can't stand that term, the persuadables, that I learned in that movie, The Great Hack, right? The persuadables, don't be so easily persuaded. Just get the basic education and understand what it means for you as a buyer or a seller, regardless of the circumstances. So if you want some more help, what you can do is reach out to us and go over to griffincourses.com or reach out and we'll explain what this means for you. Thanks for joining me.